Last week, something happened in the global financial system that barely made headlines. Yet its consequences could reach into the savings accounts, retirement portfolios, and monthly bills of millions of ordinary people. Most investors were focused on stock market fluctuations, interest rate speculation, and the latest corporate earnings reports. Meanwhile, behind closed doors, a series of events unfolded that revealed growing stress inside the very foundation of the global monetary system. What occurred was not a market crash, not a banking failure, and not a temporary economic scare. It was a warning sign that confidence in the structure supporting the modern financial world may be weakening. And when confidence begins to weaken, consequences can spread far faster than most people expect. To understand why this matters, we need to begin with a number that receives far less attention than it deserves. The yield on long-term United States government bonds has been moving higher, approaching levels that many financial analysts consider dangerous. Most people hear about bond yields and immediately tune out because the topic sounds technical and disconnected from everyday life. In reality, bond yields influence nearly everything. They affect mortgage rates, business loans, credit card borrowing costs, stock market valuations, pension fund returns, and even government budgets. When long-term Treasury yields rise, the effects eventually reach almost every corner of the economy. A Treasury bond is essentially a loan made to the United States government. Investors purchase these bonds because they are traditionally viewed as one of the safest assets in the world. In exchange for lending money, investors receive interest payments over a specific period. The yield represents the return investors earn by holding that bond. When investors become nervous about inflation, government debt levels, or economic uncertainty, they demand higher yields to compensate for the risks they perceive. That is why rising yields are often interpreted as a signal that investors are becoming less comfortable with the long-term outlook. The first major force driving yields higher is a growing need for liquidity around the world. Several countries that traditionally held large reserves of U.S. government debt have recently been forced to access cash. Some are dealing with weaker export revenues. Others are facing rising import costs. Some are simply trying to stabilize their domestic economies during periods of uncertainty. The easiest way for these governments and central banks to obtain dollars quickly is by selling Treasury bonds. When large holders begin selling, bond prices fall. As prices fall, yields rise. This process may sound simple, but its impact can be enormous because the Treasury market is the foundation of the global financial system. What makes the situation more complicated is that selling pressure is not coming from only one direction. Countries that export commodities are seeking liquidity because revenues have become less predictable. At the same time, countries that import essential resources are paying higher costs and therefore need more dollars to fund purchases. Both groups are drawing from the same pool of reserve assets. In many cases, that means selling Treasury securities. As a result, the market is experiencing pressure from multiple sides simultaneously, creating conditions that make it difficult for yields to stabilize. Normally, investors assume the Federal Reserve can step in whenever financial conditions become too restrictive. Historically, the Fed has purchased government bonds during periods of stress, helping lower yields and provide support to financial markets. However, the current environment presents a challenge. Inflation remains a concern. If the central bank aggressively purchases bonds while inflation pressures remain elevated, it risks sending a signal that controlling prices is no longer the priority. Such a move could damage confidence in monetary policy and potentially create even greater inflation concerns later. This creates a difficult balancing act. On one side, higher yields threaten economic growth by increasing borrowing costs. On the other side, intervention could fuel inflation and undermine confidence in the currency. The result is a situation in which financial markets may begin exerting influence over policymakers rather than the other way around. When investors believe central banks have limited flexibility, markets often become more volatile because participants know there is no immediate rescue mechanism available. The consequences of higher yields extend far beyond Wall Street. Consider the housing market. Mortgage rates are closely linked to long-term government bond yields. When Treasury yields rise, mortgage rates tend to follow. A family purchasing a home today may discover that even a modest increase in rates dramatically increases monthly payments over the life of a mortgage. Those additional costs can amount to tens of thousands of dollars. This means that events occurring in global bond markets can directly affect housing affordability. For ordinary households, businesses face similar challenges. Companies that rely on borrowing to fund expansion, purchase equipment, or manage operations must pay higher interest rates when bond yields rise. Projects that once appeared profitable may no longer make financial sense. Hiring plans can be delayed. Investments may be postponed. Economic growth can slow not because demand disappears, but because financing becomes more expensive. This is how a movement in the bond market gradually filters through the broader economy. Another issue receiving increasing attention is the future role of the U.S. dollar in the global system. For decades, the dollar has occupied a unique position as the world's dominant reserve currency. Governments, corporations, and financial institutions have relied on dollars for trade, savings, and international transactions. This status has created enormous advantages for the United States, including lower borrowing costs and strong demand for its financial assets. However, reserve currency status depends heavily on trust and confidence. Around the world, some countries are exploring alternatives for certain transactions. Others are increasing purchases of gold and reducing exposure to traditional reserve assets. While these developments do not signal the immediate end of dollar dominance, they do suggest that diversification is becoming a priority. Every time a central bank chooses to hold slightly less in dollar-denominated assets and slightly more in alternative reserves, the long-term demand structure supporting the dollar changes incrementally. Gold has emerged as one of the primary beneficiaries of this trend. Unlike paper currencies, gold cannot be created through monetary policy decisions. It has served as a store of value for thousands of years and remains a trusted reserve asset for many governments. Recent years have seen substantial central bank demand for gold, reflecting concerns about inflation, geopolitical uncertainty, and long-term debt sustainability. When institutions responsible for managing national wealth increase gold holdings, investors pay attention because such decisions often reflect strategic thinking rather than short-term speculation. Commodity-producing industries also stand to benefit in environments characterized by currency weakness and inflation concerns. Energy producers, mining companies, and firms involved in essential infrastructure often generate revenues linked to physical assets whose values can rise during inflationary periods. Unlike purely financial assets, these businesses are connected to tangible resources that remain necessary regardless of economic conditions. This connection can provide a degree of protection when purchasing power is declining. Meanwhile, some of the most vulnerable assets may be those whose valuations depend heavily on low interest rates. Growth-oriented companies, with profits expected far in the future, become less attractive when discount rates rise. Long-duration bonds can experience significant price declines as yields move higher. Real estate sectors dependent on cheap financing may face pressure. These dynamics are not driven by emotion or headlines, but by the mathematics of valuation. Investors often underestimate how quickly market narratives can change. A trend that appears manageable for months can suddenly become the dominant topic of financial discussion. By the time the average investor becomes aware of a major shift, much of the adjustment has already occurred. This is why understanding the mechanisms behind market movements is often more important than predicting exact outcomes. Timing is uncertain. The forces driving those outcomes are usually visible long before the consequences become obvious. One of the most important indicators to watch is the relationship between government bond yields and expected returns from other asset classes. As risk-free returns rise, investors begin questioning whether the additional risks associated with stocks and other investments are adequately compensated. This process can gradually reshape capital flows across the financial system. Money moves toward areas offering better risk-adjusted returns, creating winners and losers in the process. What makes the current environment particularly important is that several major trends are occurring simultaneously: rising government debt, elevated interest costs, persistent inflation concerns, changing reserve management strategies, and shifting global trade relationships are all interacting at the same time. Each trend alone would be manageable. Together, they create a complex landscape that requires careful attention from investors, businesses, and policymakers alike. The key takeaway is not that catastrophe is inevitable. Financial systems are remarkably adaptable, and markets have navigated difficult transitions before. The more important lesson is that structural changes often begin quietly. They start with shifts in bond yields, reserve allocations, borrowing costs, and capital flows. Only later do those shifts become visible in housing markets, stock prices, business activity, and consumer finances. By the time everyone is talking about the consequences, the underlying process has usually been underway for much longer. Today, the signals are already visible. Bond markets are communicating concerns. Central banks are adjusting strategies. Investors are repositioning portfolios. Borrowing costs are rising. Whether these developments evolve into a major financial turning point remains uncertain. What is certain is that the mechanisms driving these changes are operating in real time. Those who understand them early may be better prepared for whatever comes next, while those who ignore them may eventually find themselves reacting after the most important moves have already occurred.